Most people think banks just store your money, lend it out, and pocket the difference. The reality is far stranger and far more lucrative. In 2023, banks collected billions of dollars by turning tiny interest spreads into colossal profit engines, while most customers never see the real game happening behind those numbers. But what if everything you believed about your money's safety, purpose, and value inside the banking system was only half the story? Let's unravel the mechanics that your bank would rather you didn't notice, starting with the simple math that powers the entire industry. Hit subscribe so you never miss what the banks don't want you to know. Every bank's business model starts with a simple equation: net interest income. Subscribe to the channel to learn more. This is the difference between what a bank earns on loans and investments and what it pays out to depositors. When you see a bank's profit statement, net interest income sits right at the top, driving the rest of the numbers. For most banks in the United States, this single line accounts for 2/3 of all revenue. Here's how it works. Imagine a bank pays you 1% annual interest on a $15,000 savings account. That is $150 a year in cost to the bank. But the same bank might lend out that $15,000 as a car loan at 7%, bringing in $1,050 in interest from the borrower. Subtract what they pay you, and the bank keeps $900 before costs and defaults. This spread, what comes in versus what goes out, is the core of their profit machine. At the Treasury desk, staff monitor this gap every day, adjusting rates and loan offers to keep the spread wide. The bigger the difference between what a bank earns and what it pays, the more efficient and profitable it becomes. Net interest income is not just a technical term. It is the engine that keeps the lights on, pays salaries, and funds every other service a bank provides. Understanding this equation is the first step in seeing how banks turn small differences in interest rates into billions of dollars in annual profits. The next question is how well banks manage this spread and what it means for your money. Subscribe to follow the series and learn how these choices affect your money. Net interest margin, called NIM, is the single number every Treasury desk obsesses over. If you want clear, practical breakdowns of how banks really make money, subscribe now. The formula is simple. NIM equals net interest income divided by total interest earning assets. But the power of this number comes from scale, not just arithmetic. Take a bank with $10 billion in loans and securities. If it earns just 2% more on those assets than it pays out to depositors, that is $200 million in profit before costs, money generated from what looks like a tiny difference. A 0.5% change in this margin, up or down, can swing profits by tens of millions of dollars. That is why banks chase deposits relentlessly. Every new dollar they gather becomes fuel for more lending and investment. The larger the pool of interest-earning assets, the more even a small spread adds up. At the Treasury desk, the team's daily job is to match funding costs to loan yields, squeezing every basis point out of the gap. They track the NIM formula on massive spreadsheets, knowing that efficiency is not about making huge bets. It is about managing millions of small ones every day across thousands of accounts. This is why banks spend so much on marketing savings accounts and certificates of deposit. It is not just about attracting customers, it is about scaling their profit engine. With enough volume, a difference of a few tenths of a percent becomes the difference between a record year and a bad quarter. The math behind NIM is simple. but the stakes are enormous. If this opened your eyes, subscribe and share to learn more about how banks make money. Sam walks into his local bank and applies for a $1,000 personal loan. The approval takes minutes, and the bank officer congratulates him. The money is now in his account. If you want more eye-opening breakdowns about how money actually works, subscribe now. But here's the real surprise. The bank did not take $1,000 from someone else's deposit box or move cash from a vault. Instead, with a few keystrokes, the bank created a new $1,000 deposit in Sam's name. On the bank's books, Sam's new deposit is listed as a liability. The bank owes him this money on demand. At the same time, the loan is recorded as an asset, since Sam will pay it back with interest. This double entry accounting is the heart of modern money creation. The Bank of England spells it out. When banks make loans, they create new deposits, money that did not exist a moment before. Imagine the ledger. Sam's account increases by $1,000, and the bank's assets grow by the same amount. No cash leaves the building, and no one else's balance drops. The only constraint is the bank's confidence it will get repaid and its ability to manage liquidity, not a pile of physical cash. The old image of banks as mere warehouses for money misses this entirely. In reality, every new loan plants fresh money into the economy, all tracked by digital entries in a ledger. If you found this eye-opening, like and share, and subscribe to keep learning. Every deposit and loan a bank creates must move through a complex network of clearing and liquidity controls. The moment a customer's check is deposited, the transaction travels through the Federal Reserve clearing system, settling balances between banks in real time. Most people imagine a pile of cash changing hands, but in reality, banks use digital entries and a master account at the Fed to manage these flows. If a bank does not have enough funds on hand to cover payments during the day, it taps into intraday credit from the Federal Reserve, essentially a free line of support that must be balanced by day's end. If you want the full breakdown, subscribe and turn on notifications to get the rest of this series. Since March 2020, there is no official reserve requirement in the US. Banks are not forced to keep a set percentage of deposits as cash at the Fed. Still, most banks voluntarily hold between 10 and 13% in reserves for safety and to meet liquidity coverage rules. These rules, called the liquidity coverage ratio, require large banks to hold enough high-quality assets to survive 30 days of heavy withdrawals. For every transaction, compliance teams track these ratios, ensuring the bank can clear payments and meet obligations without delay. These operational boundaries explain why banks compete so aggressively for low-cost, stable deposits. The cheaper and stickier the funding, the more flexibility a bank has to lend, invest, and profit without risking a liquidity crunch or a regulatory penalty. If this opened your eyes, subscribe and share this video to help others understand how modern banking really works. Anna checks her bank statement and finds 5 overdraft fees in a single week, each one $27, draining $135 to cover small purchases. She is not alone. Call to action. Subscribe to learn how to protect your money. Overdraft fees, along with non-sufficient funds fees and maintenance charges, make up the second major income stream for banks after interest. At most U.S. banks, the median overdraft fee is $27 per transaction. Internal data from the Consumer Financial Protection Bureau shows that many banks reorder transactions, posting the largest debits first, even if smaller ones came earlier in the day. This tactic depletes account balances faster, triggering multiple overdraft events from what could have been a single negative balance. Core processors, like Fiserv and FIS, run these rules automatically, maximizing the number of fees per customer. Just 10% of accounts, often those living paycheck to paycheck, generate 75% of all overdraft revenue. For Anna, a $30 grocery run can snowball into 4 separate $27 fees as the bank system posts a larger bill first, then lets the smaller ones fall into the red. These mechanics are not accidental. They are designed to turn customer mistakes into a reliable, high-margin profit stream. Call to action. If you want to stop paying hidden bank fees, subscribe and share this video. When the Federal Reserve began raising interest rates in 2022, banks moved quickly to adjust. Subscribe now to get clear, practical explanations like this. The Markets Desk. At major banks, watch their loan portfolios and deposit rates with one eye on the Federal Reserve and one eye on their own bottom line. As rates climbed, new loans and adjustable rate mortgages shot up almost overnight. Credit card annual percentage rates jumped from an average of 16.5% to nearly 20% in just a few months. But the rates banks paid to savers lagged far behind. Most savings accounts offered less than 0.5% well into 2023. This gap was not accidental. Banks reprice what they charge borrowers much faster than what they pay depositors, locking in higher profits with each rate hike. Industry data from the FDIC showed the average net interest margin across U.S. banks hit 3.25%, the highest in over a decade. That extra spread meant billions in added revenue, all while depositors saw little change in their returns. The FDIC insurance limit of $250,000 per account kept deposits flowing in, even as rates elsewhere rose. This repricing asymmetry, faster hikes for loans and slower bumps for savings, became a windfall for banks. The system's design lets the Markets Desk turn every Federal Reserve move into a profit lever, amplifying gains as rates rise. For most Americans, the result is clear. Banks benefit from policy changes long before customers ever see higher yields on their accounts. If this made sense, subscribe and share so more people understand how banks really make money. Every time interest rates shift or a new fee appears, banks quietly recalibrate how they profit from your money. As regulators debate new rules, the true mechanics remain hidden in plain sight. Understanding them isn't just power, it is protection. What will you do with that knowledge? Subscribe now to learn more and protect your money.